Hey guys, I'm Big Mike. Like always, I'd like to thank you for being here today. Today, FuturesTrader71 is back, and he's going to talk about trading on the hard right edge. Specifically, he's going to review his volume profile methodology, kind of walking through a day and going over his process. The agenda briefly is planning the day using volume profile, areas of interest to trade from throughout the day, how to execute and manage your trade according to your plan, and some of the common pitfalls that a lot of traders struggle with. So as you guys have questions today, just type them into the questions box and they will show up to both Anthony as well as FT71, and they will both do their best to answer everyone's questions. The recording will be posted for the webinar sometime tomorrow on BMT. All right, guys, give me 1 second, and I'll be turning things over to FT71.
Good afternoon, everyone. Can you all hear me? Looks like I'm on the air. Okay, so thanks for coming in. I know it's valuable time on your Saturday. We'll try not to make this one a feature film length discussion here, but again, I'm going to try to give you what I think is useful to you. So bear with us. I do have the support of Andrew, who's an associate of mine. He's a broker at Vanguard Trading, my brokerage firm, and he's going to be able to answer questions. So if you receive answers from a guy named Andrew, he's trying to help me out. So today we're going to talk about trading on the hard right edge. What is the hard right edge? It's the spot on your chart to the far right where new prices are being printed and shown to you on your chart in the market. So let's get going. First of all, I'm going to read you your a very important risk disclaimer, just like Mike displayed. You need to know that derivative transactions, including futures, are complex and carry a risk of substantial losses that are not suitable for all investors. The information I'm sharing here with you today during this presentation is for educational purposes only. It is not intended for use as trading or investment advice, and then, as always, past performance is not indicative of future results. So let's start out with what we need to do as traders. Now, trading on the hard right edge is not about throwing up a chart and using some fancy software and just clicking away and hoping that you make money. It all starts with your homework, okay? So there's going to be a fair amount of discussion about homework. It's a surprise to me when I talk to traders that I do try to help out either through my Twitter feed or by writing to me on my website or whatever. Struggling traders in general do not do any homework whatsoever. They simply rely on coming in and intuitively trying to pick spots to trade. And it's a lot like when a person first learns how to drive. They just want to drive. They don't really know that there are rules that they need to know. They just want to know how to make the car move. And that's what happens with trading. And so it's key to emphasize homework, because the fact is, without homework, you're not going to be consistent. I'm sure some people get away with it. When I first started trading as a scalper, a high volume scalper in equities, as well as in futures, I didn't do homework. I had CQG. I think we were paying about $800 or $900 a month for it, but I never looked at it. I never looked at the chart. I just looked at the dome and just traded the dome. That game is over. It's been taken over by high frequency trading and so on. And now it's a much more intelligent game, so to speak. It's a much more strategic game. Trading has gone from looking like a high-speed video game that pays out to more of a chessboard. And in order to excel or succeed in chess, you need to understand what pieces you're willing to risk for the steps forward that you want to take towards your goal of checkmate, right? And so trading has become more of a strategic type of enterprise. And scalping mindlessly is not a game that most people can play anymore and succeed at. So homework is your time to figure out, based on the information you have, what your game plan is for the next trading day. There are those of you who come in really early in the morning and and do their homework right before the market opens, and there are those who spend 2-3 hours a night the night before, right after the close, doing homework. It doesn't matter when you do it. It doesn't matter how you approach it. Just make it so that it's something that is methodical and consistent from day to day. And we'll talk a little bit about what you're looking for in the homework, and I'll go over some of the things that I do for homework and why. So homework's for analyzing. Trading time is for execution. And that's a key thing, because you don't want to analyze and make decisions on trades while trading is going on. There's a small number of tasks that you need to watch out for, but those tasks during trading really should be confined to finding a spot to execute your homework, finding those things that you envisioned would take place for you to execute one of several hypotheses or setups within your homework. But what you don't want to do is to start doing research and overanalyzing and throwing up, different trend lines and looking at your daily chart and whatnot while you're trading. Trading time, this may come as a surprise to you, but trading time is execution time. So the closest analogy, and whenever I've trained traders and so on, I've found that speaking, using analogies creates more aha moments for a trader than just saying it like it is, just saying what they need to do. The best analogy to your homework is like being a pilot. What a pilot does not want to do is to sit down, buckle in, head for the runway, take off, and then figure out what his flight plan is. That's not what you want to do. You can do it, but generally you're required to book a flight plan, and generally you want to know where you're going to take off from, where you're going to land, what waypoints you're going to use to get there, and that makes for a safer, more efficient experience for yourself, your passengers, for everybody else that's up in the air, for the airports and so forth. And so that the trading is much the same. You want to create your plan, and then what you want to do is wait for your spots and then shift into what I call stalking, almost like stalking a prey when you hunt. You're looking for certain things to line up according to your homework, according to the limited number of things you watch, and then you execute your plan. That's how you trade on the hard right edge. Anybody and everybody can pull up yesterday's chart and say, yeah, this happened, and you could have gotten short here, and you could have gotten long here. But most of you who've been through a lot of webinars and so forth, know that that's easy to do. Hindsight's 20/20, and it's actually pretty useless. What matters is for your homework to be in place when you come in, as if that is your flight plan, and when it's time to turn the engine, pull on the throttle, and coast to the runway. It's an automated process. It's a process that is honed, that is practiced. And that's really what it takes. Narrow it down. If you're the type of person that's part of a chat room or Twitter or whatever, and you come in and you start paying attention to 6,000 different spaghetti lines on your chart, you're going to have a hard time, because for every line that says you should be long or there's support here, there's another line that says you should be short. You know, the stochastic is telling you it's oversold, but your RSI says it's not, and so which one do you go with? One turns with the other, so you don't get you're taking a lot of price risk for more information and so forth. What you want to do is narrow it down, narrow your homework down to just a handful of setups. I'm expecting A, the market to open here, possibly test here. This is what I'd like to do when it tests here. Or the market opens here, it breaches below, it rotates, it might test this far, it might not. Here's what I would do in that situation. And so that when the market opens, your time is spent simply waiting for the market to come to you, to come to those areas, because trading in the middle of nowhere is hardly an edge. It usually isn't. It generally results in a one or two poor trades, and then your day is just messed up. You're just chasing the money from that point on. And then finally, when you've narrowed down, like I come in with at least 3 hypotheses on the day. And once the Globex session is done and the market's nearing the open at 8 a.m., I go into this chat room that's a part of our brokerage here, and I basically lay out what I see based on yesterday's information and the overnight information, and it's narrowed down to about 4 or 5 hypotheses that I want to execute on. I went from executing, I would say conservatively, 200 to 300 trades a day, scalping a lot of volume, 1,600, 1,200, 1,600, sometimes 3,000 round turns in a day, depending on the activity, to 5 setups that I expect. And so that allows me to just relax in my trading. It allows me to become really, really good at honing in on those particular setups, okay? And then the thing that I do while I'm talking about, you know, in the morning, while I'm typing out what I see unfolding for the day, I visualize it. I just imagine, you know, I come in, I see the market's trading 1383, 1384. I imagine, all right, I have 1386 or 1388.75 above, which is the most recent high. What if it pushes to that? So let's imagine, and this happens almost automatically for me because I've been doing it for so long. What kind of a push do I expect? What would I be looking for to execute a short against that first push, if that's the plan? Just visualize what would happen, and that's going to help you while you're executing. When the market's actually playing out, what it's going to do is help you not get caught up emotionally in the craziness that could take place when you're emotionally involved in trading. When you feel like, oh my God, it's moved so quickly, I didn't get my long, so I'm going to try the short all day long in an uptrending day. So visualizing is an important piece of the puzzle. All right. Let's take a step back for a moment and again talk about risk. Why? Why do I keep going on and on about risk? It's all about risk. Risk is something that makes or breaks you as a trader. I can't emphasize it enough. It is there in red on the slide. It's in everything that I do or put out there. Risk is key. And as to a trader, not knowing the type of risk you may be getting yourself into and not basing your homework on the type of risk that you want to to be comfortable with. Leaves you with a lot of emotions. It is risk that brings in the fear that causes you to lose your mind, to act frantically when the trading actually is taking place. It's without risk there would be no fear, and so risk is part of the game. People don't want to lose. People emphasize most of their effort and time on being right. I don't try to be right. I just try to trade the probabilities. I'm going to say that again. I don't try to be right. I don't try to be right. I try to emphasize the probabilities. All I'm interested in is what is more likely to happen over the other. What's more likely to take place in this area right now that I designated as my area to do business from my homework? What is more likely to happen over the other? Okay, so sometimes that's a 50-50 proposition. Sometimes I have substantial homework and experience to know that it's a pretty good setup that has a fairly high probability, and so I don't need to wait for information. So the two types of risk there are information risk and price risk. Okay, when you take information risk, when you take, I actually got the slide wrong. When you want to take, when you take information risk, essentially what you're saying is you are willing to forego better information for a better price. When you take price risk, I can't believe I got this wrong here, but when you take price risk, essentially what you're doing is you're waiting to get better information, but you're risking a worse price. Okay, so disregard this slide. I got this backward. I spent most of my morning dealing with my website's host, who's messed up my website, which is back up now. So I apologize about this, but I'm going to move on because I don't want this to linger. But the fact is, I'm looking to, with my homework and with all the analysis that I do, and I do probability analysis. I bring in data sets through my charting package, and I figure out what types of days there are, what types of openings there are, the probability of a trending day given the current situation, and so forth. And then I look for the area that I want to interact with the market, what it's trying to do, and I try to determine what is more likely to happen over another. And then I start to stalk the particular trade according to my plan. And then the next part, which most people can't get right, is executing the trade almost mechanically. And I'll give some examples of that. What is the objective of your homework? Notice that we have not talked about the hard right edge or looked at charts yet. Why is that? Because the tools that we are using get a lot more attention than the information we extract out of them. And that's because we are more interested in making sure the chart, has the highest tick of the day, right? It's not off by a tick, that we have the greatest data feed, and we have the best execution platform, and that we're using this tool for a pitchfork and that indicator with this many periods and so on and so forth. When actually the question you should be answering is, how is it that how can I do my homework such that using the information the way I like to see it, and in my case I like to see it in the form of a volume profile, how can I get enough information to be able to anticipate the move before it happens or as soon as it's happening? Because in trading, once the move has happened, it's too late. You're taking a whole heck of a lot more price risk once the move has happened. You're waiting for more information, and you're risking a worse price, a price that's much farther from your stop, and so on. And so my focus during homework is, what do I need to do to find the context that's relevant to my time frame, which is a medium term, a longer term scalper type of horizon. What do I need to do? What information do I need to put together to be able to anticipate the move away from the area that I want to do business? What is the unfair price that the market's going to react to? And we call those support resistance levels. They're unfair prices. Okay, so your goal in completing your plan for the day is to simply execute during market hours. So by the time I'm done doing my homework and doing my market recap and so forth, and the market starts at 8:30 Central Time, Chicago time, I'm in execution mode. It is now my job to determine the quality of the auction, who's got the upper hand, and which one of my 3 to 5 hypotheses is likely to come into effect. And then from there, my execution plan takes over, and then it's time to just put the trade on and manage it. And then the first objective of managing the plan is mitigating risk. I'm trying to reduce risk as quickly as possible, and I'll show you how I try to do that. Again, it's not time to research the market or do homework once trading has started. Context. What is context? This is the most elusive part of your homework. Trying to figure out the context of the market. So the first thing you need to know about context is, what is your time frame? If I could see you while you trade, one of the people that are in here now, if I could look in and ask you a question in the middle of a trade, and I asked you, what is your time frame? What would your answer be? You should know what that is. Are you a swing trader who likes to hold things for 2-3 weeks? Are you a scalper who's looking for 2-3 ticks? Are you a day trader who's looking for trading extreme to extreme, let's say, holding a trade for 6 hours, 6-7 hours? Those are important things to know. So if you're a scalper who's scalping for 2-3 ticks, do you care about the monthly chart? Do you care what the monthly chart says? Do you care what the daily chart says? Do you care about the hourly chart? No, you probably don't. You're scalping for ticks. You're scalping momentum. So knowing your time frame is the first step towards context. And again, this is about, we're talking about trading on the hard right edge. And this is the bottom of the iceberg that is underwater that nobody sees, which makes up the base for what we see, the tip of the iceberg on top of the water. And most attention is being spent by traders, and this is why it's difficult to succeed in this business. Most of the attention is spent on the tip of the iceberg. What can you see above water? And that's not the most important part. What's important is, what is the foundation of this? And this is why we're covering this. This is why I'm not showing you a chart going over some method or something yet, because you guys need to go through this. It's not sexy. This is the unsexy part of trading, but you need to understand this about yourself. So what you want to do is decide what time frame you want to trade in. So in what time frame do you want to interact with the market? What will affect your time frame? What things affect your time frame? If you're someone who's holding for 2-3 weeks, some of the things that will affect your time frame are geopolitical risk, currency risk, economic releases, things like that. That'll affect your earnings. You know, we're in earnings season right now. Earnings are going to affect that. For a scalper, not much affects your risk other than the entry and exit of a larger time frame. So when a fund wants to come into the market or come out of the market, it's going to affect you if you're a scalper, because they may drive prices in a direction for a sustained period of time to get a fill for, say, 50,000 contracts in the S&P. It might take 7, 8, 9, 10 prices to do that. If you're a scalper looking for 2, 3 ticks, that's going to affect you. So how do you detect that? Are you reading the tape to detect that? Are you filtering your tape for larger sized orders? Does it seem like, how skillful are you at reading the velocity of the tape? What about the bid offer? Are you able to read what is fake and what is not? And as a scalper, I can. I could do that very well, and that's really what my edge was. What is relevant to your trading? If you're a scalper, do you care about the monthly chart? We just talked about that. So let's look at a plan for the day. So I'm just going to run through what I usually look at, okay? And I'm going to make this brief. I covered this in webinar 4.1 on my website in detail. I don't want to rehash all of it. But essentially what I want to do is show what I'm looking at. So let me switch screens here. So this is my main S&P mini screen. I start the day out by looking at, I do this thing, call it macro to micro. And so I basically start my homework by looking at the trading calendar. So I receive a trading calendar that I pay for that covers pretty much everything under the sun, probably too much information. It gives me anything and everything that is being released in Europe, any speakers that are due, earnings for the day, how important are those earnings, you know, what percentage of the market does that control, does that company control of my market, the S&P 500, let's say. And then it tells me the speakers, if there are any auctions, if there are any expected surprises, and so on and so forth. So I look at that first. Next, I look at the big picture. So this is very colorful and so on, but really once you see, hang on, I got some extra lines on here. So what this is it's a, since I only trade during day trading hours, I don't really concern myself too much with the overnight, although I use the information from the overnight session or the Globex session, okay? This is a 405-minute day session only chart. Each bar represents one session, one day, and so if we look at the most recent days, so this represents what we traded Friday right here, a high of 83.25 and a low of 73.50, and so we have a bar for each day, very simple. But it's not a daily chart, it's a 405-minute chart because I'm only looking at RTH, the day session. And why do I only look at RTH? I understand what a futures contract is. Do you all see the chart? I guess there's some trouble with seeing the chart. Can you see the chart?
It's fine here.
Okay. I only concern myself, I mainly concern myself with the day session because the futures contract, and I won't get into what a futures contract is, I'm sure most of you know. The futures contract is based on some cash instrument. The cash instrument in this situation is the S&P 500 index. The S&P 500 index contains 500 stocks, you know, large cap stocks, and those stocks trade mainly during the day session. So for the futures contract to represent the index, it's representing the movement of those stocks. So at any given moment, I can generate that index, add interest to it, subtract dividends, and the price of that cash index, the SPX or the S&P 500 cash index, you throw in all the dividends and everything else and interest, I can compute the exact value that the S&P 500 future should be. That's not the case overnight. overnight it's trading differently. What it's doing is it's trading a correlation, an intermarket correlation with other products. So essentially it's being driven by the Euro stocks in Europe, it's being driven by the Nikkei, it's being driven by movement in currencies, the US dollar basket, the US dollar index, and a whole bunch, and every day it's something different really that's driving the S&P. So the overnight trading happens on much less volume because there's no arbitrage between the cash instrument or the spiders or the SPX index created by, you know, the high frequency machines that are arbing, taking advantage of opportunities between the future contract and the price where it should be versus where the cash index is. So a lot of that volume doesn't exist, and I need to have that substantiation to know that the move that is happening because it represents the actual cash index. So I'm not so interested in the overnight session, although a lot of action happens in the Globex session. Now don't misunderstand me. I don't disregard it. I come in, I look at it, I pick up cues from it, but I trade the RTH session from 8:30 Central to 3:15, and then of course I trade the you know, numbers that come out early in the day before the cash session is open. So I do take it into account. Oops. I do take it into account, but it's not part of my homework, so to speak, early on. So what this chart is, it's called the composite. Okay, and I call it the composite because it puts together all of the information that's occurred since the dates shown here on the top left corner. This chart is going back to September 7th of 2005. Okay, and the volume that you see on the right, this colorful rainbow colored ribbon, is every contract that has traded at those prices, and I'll zoom in so you can see it. You see, it's at 1377, this many contracts traded, and I can find out what that is. So at 1377, since September 7th of 2005, on a continuous contract adjusted basis, has traded 959,706 contracts at that price. So this is a volume profile going back to September 7th of 2005. Okay, and I call it the composite. And it's built on 405-minute charts. So my day starts with reviewing the story. What is the story, right? The market hit a peak in 2007. We had our wonderful crash down to 603. Again, the prices are rollover adjusted prices using DTN IQ feed. The market then went on its recovery through 2009, 2010. Then in the summer of 2010, we had the big move that came on the heels of the news on Greece. We had chop during 3 months, I think late, yeah, it's early August all the way to mid-October. Then we started to break out of it with the bailouts and whatnot. Then we went into balance because that came into question, and then we started the year basically trending up with some balancing in between. So that's the main story behind what the S&P has done on a daily basis during market hours. Okay, wherever there is balance, whenever the market goes into balance, like this zone here, as soon as it breaks out of a range and starts to fold on itself like this, where it's moving up and folding down, moving up and folding down, I create what's called a micro composite. So if we were, let's scroll this chart back. As these days started forming, I start to look at the composite for that period. So you can see that composite, and that what that shows me, what the composite shows me, is what prices were doing, what these 4 days were doing volume-wise. And as the market breaks higher, I create another composite. Okay? So I look at that. I look at those days together, just those 2 days. And as the market falls back into the prior composite, I take and I stretch. So this day here brought us into the composite of late October. I stretch that out, and now I can see what volumes traded within this composite. If you remember, for those of you who attended the first talk I gave on Big Mike, I talked about volume and volume profiling and accepted prices and rejected prices. And that's really, I'm applying the same knowledge to this. I'm looking at where did the market trade with volume, right? So this is a high volume area right here, high volume node. There's no volume down here. Prices are rejected. High volume node up here. Prices were rejected through here. High volume node. Prices were rejected. The highest volume node is right down here, and that's where the market liked prices. The day after that, it gaps way down here, so I extend the composite to that, to include that volume. And then ultimately what I end up doing is including all of the volume. I create a volume profile that incorporates all of the volume until the market breaks out of that range. So as soon as it goes out of the highest point of that composite, it stops, because now the market is seeking newer prices or seeking higher prices. It's no longer in balance, okay? And then I look at, and then I do the whole thing over. I look at that and I say, okay, where did they like prices in here? Why am I doing this? It seems kind of odd. I could draw trend lines, I could draw pitchforks, I could throw a moving average, and it'll tell me that the market's sideways. The reason I do this is because I want to see inside the bar, and that's the only way to do it. I want to see not only that the bar's high is here, and the bar has a high of 87 in this area, a low of 67, so that's my support resistance line, so I throw up a bunch of lines and that's where I trade. No, what I want to see is within these days, where did most of the trading happen? So I grab those days and I can now see. Oh man, hang on. So I can see within those days where the trading happened, right? So that's what it's for. So where did the auction happen, where prices were really accepted within this range? The black right here is the highest volume price. That is the most accepted price, and this range is 1280 to 75. What prices were rejected and so on. So that's what I'm doing on a bigger time frame basis. So that frames my day. As we move up, you can see that we hit another balance area, then we gapped up above it, retested. The high of this balance area is 24, the low of the next balance area is 26. So sellers could not come in and bring the market back into the prior balance. Chances are it's going to keep going away from that balance area. I can do this with any product, and I do it with any product. I trade the S&P 500, which is what I tweet about most because it's the most popular product. But I trade the DAX on high volume. I trade the Russell. I trade the NASDAQ if I see anything interesting in there. Some crude oil, some gold, and it's all the same method. It's the same method, and I'm just constantly trying to determine where did the market like prices, where did it not. Okay, and that's what shapes my thinking. Why? Because I like thinking from an auction perspective. Because we are driven by an auction. If the iPhone was sold tomorrow for $50, how long will prices remain at $50? How long do you think? Anybody? What's the fair price of an iPhone on a new cell phone plan, on a new contract? What's the going price on an iPhone? $300, okay, some of them, the 16 gigabyte one or whatever. No, on a new cell phone plan, not the actual phone itself. $199, yes, that's what it is at Sprint, at Verizon, right? That's what a new iPhone costs on a new cell phone plan, 2-year plan. What happens if AT&T, in its effort to gain back its influence and market share in the iPhone, what if they offered it to you for $50? Would you buy it? What if the inventory at $50 is limited? How much volume would happen at $50? How much? Huge? No, it wouldn't be huge. No, it's not. Very limited, right? If I have 100 jars of peanut butter on the shelf, and it normally goes for $3 a jar, and I put it out there for 5 cents, how quickly will that supply be gone? Very, very quickly. Those are unfair prices, but they're unfair prices to whom? To the buyer or the seller? To the seller. So if you're the seller and peanut butter is on the shelf for 5 cents and it's just flying off the shelves, what would you do? Come on, think in auction terms. You would raise prices very quickly. At what point will prices stop going up? When they become unfair, when there are no buyers, when the buyer's no longer enticed, when all you have is sellers, right? And then what happens if price goes back to $3? So it went from 5 cents to $15 a jar with an infinite supply. What happens when I bring prices back to $3? That's a fair price. So at a fair price, do you expect continuous buying and selling at that price? You expect business, a lot of business to happen at that price? The buyers see it as fair, sellers see it as fair? That's what this is. That's what this is. The bigger volume nodes, and this is not a very clear one, but let's look at the most recent because that's the most relevant. Here's the most recent balance area. We had a 2-day balance area that was the 4th and the 5th, and then we broke down through there on the 9th, broke even harder on the 10th, and then we had an inside day, which is expected on a high volume, higher range trend day. We have an inside day, a choppy day, so to speak. Then the next day, it ripped people's faces off and went the other way, right? But it's still imbalance. It's still, at this point, the market was in balance. The most traded price on these 3 days of selling was $13.67. $13.67 was the price perceived to be most fair. Unfair prices in this situation were 63, 60.75, and of course the low almost always has little to no volume. So the most favorable price in this area is probably around 62.75, this low volume node right here, all the way up into this thinner area. Okay? What happened on the day we came in and had this big buy day? Our fair price moved from here to here on a sharp high volume node. So the point of control moved from whatever it was, 62 what? 67 to 77 and a quarter, 77 and a quarter, and we see it reflected here. You see it reflected on the composite. Believe it or not, this 77 quarter existed here before this day happened. Okay, so 77 again became the most fair price in this region, and so the market's accepting higher prices. The market has received information such that it is willing to trade at higher prices. The next day we sell off. Prices didn't move. Even though the market has moved away from the most fair price down to that least accepted price. Remember I said 62.75? This day stopped a couple of ticks short of it. If you look at the Twitter feed, you'll see that I kept saying 62.75, 62.75. The next day opened in the upper part or upper middle part and sold off, moved the most fair price of this region to 66.50. Do you follow what I'm saying? Okay. Then it broke higher, 88.75. The most fair price didn't move. Okay. We had an inside day after a rally day. Price moved up to 82.75. Now there are enough sellers up at this price and buyers agreeing on price to move the point of control to 82.75. What does it do? The next day it comes back and it tests the lower accepted price from the previous composite, and it goes through it by a couple of ticks. It went to 65.50 that day or something, and that most accepted price is 66.25. Since then, the market traded higher. Price shifted back up to 82.75. So what's happening here? The market likes, under certain circumstances, likes 82.75 or 66.50, 66.25. Okay, those are the two most fair prices, with a few in between. The one that I like is 72.5, and then of course 77.25 is basically the pivot in this area. It just keeps sloshing through it. It's trying to it's testing the extremes of both sides of the 77.25. And then you have yesterday, and the point of control still up here at 82.75. We tested it yesterday. If you traded yesterday, we tested it, busted through by 2 ticks, I think, broke through by 2 ticks, and then sold off to the other side. And I'll show you what I put up in the chat room to discuss going into this day. Of course, those people who like chart patterns will, have probably thrown up this triangle, including these 2 balance days after the breakdown. This triangle, and of course there's a bear flag that everyone's anticipating, or a lot of people are talking about anticipating that it's going to break down lower. I don't care if it breaks higher or lower. All I care about is what's the prevailing force in the auction, and if the prevailing force stays in control, where is it likely to go to find that unfair price again? And that's what the market does. It goes from fair prices or balance to an unfair price to test, to entice the other side. So the market advertises higher and higher and higher and higher prices until there are enough participants motivated to sell at those prices for it to stop and turn. Usually it shifts the point of control because there's a fight there. To stop and turn, and then it turns around and it tests the other extreme, back and forth and back and forth. And many of you see that action. Many of you will see that action in the form of a stochastic turn or a MACD turn, which is following price, because those are built on the closing price of some prior bar going back so long. And I know that that's, I don't use that. I used to use those, but I don't use them because I like to see it in its purity. And there is no right or wrong way. Both ways, as long as it works for you, are efficient for you, and that's fine. But I prefer to see the auction, and I prefer to see it in the form of how much really traded. So what have we done here? The auction has tested the 53.5 peak, tested both sides from 70.50, which is a key level here, 70.50 all the way down to the 60.50 this day here, all the way down to the 60.50, and then it tested from the 70.50 all the way up to the highest in the range, the highest accepted price in the range, and failed back through, and then it came back to the middle portion where the highest accepted price is, which is 77. So we have not been able to move away from the 77.25 really, and we just keep testing peak to peak to peak. I have to tell you, of the entire composite, as it's shown here, this region that we're in is the most ambiguous. So it's hard to give you a very clear example of an auction rejecting prices cleanly. it's tending to slosh around in this area because we're not getting really nice peaks like we have down here, nice peaks and valleys. I'm not able to change the date. I would love to revert back to looking at 10/11/07, that swing going forward. But if you look at the way the profile is in this region, it's completely blunt. It's dark. There's very little volume all the way through. And that's what we're contending with. We're contending now with prices near the 1400 level that are kind of accepted all the way through. So the market's just running through stuff. And I'm sure if you trade, you notice that the market's tending to run through prices quite often. Anyway, back to homework. So I read context this way. So the point of this chart is to give me the context of prices and what they've done. Okay, let's clean this up. So I use this chart to basically read what is the context. I'm continuously answering. What has the market done? What is it trying to do? How good of a job is it doing in getting there? And in my trade, when it's time to execute the trade, there's an additional question that asks, what is more likely to happen from here over another? And that's all I know. I won't get into the 50-50 discussion. I think Mike would chop my head off. But from there on out, it's either a winner or a loser. And all I'm trying to do is figure out what is most likely to happen, and if it does happen, how far or what area is it looking to test? Let me reset this so I don't forget. Okay, so once I come into the day, I'm basing my general ideas on my context on this composite chart. Where do I go next? Oh, somehow I've stopped this from shrinking back to where it's supposed to go. So this intraday chart looks awful busy, doesn't it? Actually, it isn't, because it's showing you everything from high to low. I'm interested in 15 points of range. And the lines are very simple. So let's look at this. Let's clean this up a bit. Coming into the day, we'll look at the hard right edge. We're going to look at the day session only. So from the day session only, let's forget about Friday and look at Thursday coming into Friday. So Thursday, we had this kind of a trade. The market tested a naked point of control from the past, which comes from the 17th. The 17th rallied all the way up, found resistance. That's the day where we did the 88.75 high. Rallied all the way up, double top, and then the point of control moved to the high of day. Look at how much traded at the high of day. So in order for that much to trade, sellers have to be very active. People have to see an advantage in selling against the buyers to create that much volume. And then the market sells off into the close. So notice I'm always going over the story. Like, what is the story here? Read the story as it happens, kind of like watching The Sopranos and trying to follow along as to what happened and who got murdered and who's married to whom or whatever. The market's the same. It's constantly singing and telling you a story. And the story gives you context. And I'm only interested in the story that applies to my time frame of trading. Okay? So this day, the point of control moved up and it held at 86.75. So the charting package takes that line and projects it forward, just like it does to a gap. So whenever there's a gap, let's scroll down. So this is a gap price that's orange down here. So I know it's a gap price when the market's trading. I don't need to note it down anywhere else. I can see it on the chart. So 86.75, the next day gapped down overnight. It gapped to where? It gapped to the extreme of the low volume prices. So this is a rally day. Notice the market took off hard. Can you see this chart clearly? Let me move back in time so that you can see. So this market took off pretty hard. Okay? When it does that, you have price discovery. There's price disagreement. So they agreed on prices in the morning. You've got this nice fat profile, lots of volume in here. Then they break away from it. It rests for a little bit, and then it continues breaking and breaking and breaking. And whenever it breaks higher on no volume, it leaves this low volume node or a low volume node zone. These are unfair prices. So in this situation, from 77.75 down to 76.50, remember the price, 76.50, okay? It's the lowest since we broke higher. It is the first area of disagreement on price after this volume, high volume node, okay? So we need to remember that price. It broke higher, and what it did is it formed a low volume node from 82 down to 79.75, and from 77.75 down to 76.50. Those are prices that were too cheap. Sellers didn't want to sell there, and buyers were aggressive enough to push prices up and keep trying to entice sellers to step in. Sellers stepped in at 88.75, and then they really stepped it in at 86.75. So that's a key number to have. The next day, it opened right at this low volume node, 79.75. I would have liked it at 76.75 actually, but it opened at 79.75, tried to test lower, tested this little balance area, very minor balance area. The buyer kicked in, and the seller came in and held prices off at this high volume node, and then we went sideways for a little bit. Then it broke to the next side, to the other side of the low volume, and it continued up, and it tried to reach for the most traded price of the prior day, and it couldn't. Okay? 2 tries, 85.75, 85.50, just couldn't get it. Look at the shape of this profile. This is Wednesday. The shape of this profile is balanced. The market loves these prices. Okay, so on this day I pay attention to value. Value for this day is 83.75 all the way down to 80.50. I note those down. Okay, so what do I have in this region? So forget about all these other squiggly lines and stuff. They have a purpose, but it's not important right now. Just read the big picture. The big picture is the market is in balance after this big trend day. The market finds that prices between 84 and approximately 80 are fair prices. So it trades there. Every time it breaks out, it comes back in. This was a good trading day. Okay, the market's in balance. Balance, so imbalance leads to balance, leads to imbalance. So what do we expect the next day? We expect imbalance. We're looking for somebody to push prices way out of whack to try to test out, probe for buyers and sellers, right? That's the point of the market. That's the purpose of the market. So now we move on to Thursday, and this is the story. Obviously, I don't do this every night. I know the story because I was here and I watched it. So this is not part of my homework, but I'm bringing you to the point where this is the kind of knowledge that allows me to put on a trade with sides and manage it comfortably. This is the part that people don't like to see. They like to know that I can get on and say and tell you where to trade, and then you do whatever you need to. Look at this day. It opens in value in the fat part, tests lower, is unable, tests the value high of the prior day, is unable. We have the 9 o'clock number that came in, Central Time, Chicago time, came in, broke the market down, found buyers at 74.50. What's 74.50? Look back. 74.50 is right here. This is the most accepted price on that rally day, 74.50. What is 77.50? It's the middle of this low volume node. Nobody liked these prices, and that's where it found support all the way back to the most accepted prices, okay? And then in the end of this, I'll tell you what I'm looking for Monday. And you can see for yourself. I have plenty of videos on my website, by the way, where I go through homework. I do a homework session, and I actually record the next day and compare my homework to how the day unfolded to kind of show you that this isn't hindsight 2020 nonsense. So once it goes to the accepted price from that rally day, it shoots straight up and stops one tick short of the most accepted price of that rally day, and then it can't find any buyers. The market is just not able to find enough fuel to break on through the 88.75 and keep pushing. The market's in balance. So I'm not going to take breakouts. I'm looking for unfair prices back to the middle. I'm in that mode, and if I can find a reason for it to break through, then I'll start looking for a trend type trade. And that's not my forte, but that is part of what I want to do. So now the market breaks through the balance zone. It breaks through the rally day, so see 71.75. Breaks through the rally day, so now I have to start looking at the composite. Okay, 70.50 is key, and then the next area of acceptance starts at 65, 65, 70, 65 quarter, all the way through to 60.50. So that's as soon as we break out of the 71.75, I'm looking for 65 quarter. I'm looking for the 63.75 point of control to be closed, and if it has any fuel in it, I'm looking for 60 quarter. Okay, so that's what I'm looking for on this chart. That's the homework for that next day, Friday. So Friday, we have the most accepted price at 76.75. Remember the 76.75, which was a rejected price from Tuesday, is now the most accepted price on Thursday, 76.75. Okay, tested and retested, and we're stuck in this big 77 quarter area. Again, it's hard to get through the details here in the time I have, but it may seem like voodoo to you, but with a little bit of background, it kind of makes sense. Friday opens in range, in value, so the areas I want to look at, and I'll show you what I put in the chat room here coming into Friday. So I do this in the morning. So I just block people's names for privacy. So this is the brokerage chat room that we have. This is just a transcript of it. I can't show the actual room because it reveals people's names, and I don't want to do that. So I grab the chat log, which is just a PDF file. I come in and I say 71 quarter and 80.75 are the overnight extremes, double distribution on the profile. So I do look at the overnight session, and that's the information I gather from it. This is what's important. 3 distinct distributions on the volume profile yesterday. I'm talking about Thursday's volume profile. So what I'm saying here is there are 3 areas. Let me grab the pen for a second. Three distinct areas in here. Well, that's not a nice color. Again, we're talking about the nuts and bolts here. 3 distinct areas. There, and there. Right? Actually, this is really one area of rejected prices. So that's what I'm outlining in this homework. 3 distinct areas that the market felt balanced in before it moved to the next, to the next, to the next. We got to pay attention to that. 3 distinct areas, 86.5 to 80, 80 to 74.5, 74.5 to 65.5. Currently trading in the middle distribution of 76.75. Okay? So coming in, I know that it's trading right in here. So now I'm going to look at 80, which is the first price it tested. If you look at this chart, it opened, tested 80, came back down to VPOC, took it out by 2 ticks, tried again for the 80, broke out by a couple ticks, back to VPOC. So now we know that the buyer's active at this the most fair price of Thursday. Okay, so I'm not going to look short until it starts to break for the lower volume node. 74.50 was key on Friday. 74.50. I want to see it. If it breaks through VPOC, I want to see it down to this price and through, and now I can catch a runner. Okay, so it tried multiple times, and it couldn't. So I'm looking for the long side. I'm looking from the long side. And what am I looking for in the long side? Since it tested 80 a couple times, I'm looking for it to test the most accepted price of the prior day, Thursday, 83.50. What does it do? It tests 80, pulls back to VPOC, tests 80 again, pulls back to VPOC again, tests 80.75, is not able to pull back anymore, comes back to the open, and bam, it goes right to the most accepted price of the prior day, and then there's nothing. It can't find any further buyers. They're just not interested. So we sit sideways for the day, and then we start to run through. Now, that day's profile becomes more important. It starts to run through. So what does it do? It rejects the same price again. Look at that 80 quarter. It looks like it's notched out of this profile. 80 quarter lines up with the 80 over here, lines up with the volume profile over here. Anything below 80, I'm looking short. What am I targeting for the short? 74.50, and hopefully through to test yesterday's lows. We ran out of time, and that's really what I looked for in my, when I was trading yesterday. That's what I looked for. So that's the general perspective. So what did we do yesterday? We tested inside of the prior day's value. So we are stuck in this dark gray area. It's a prolonged profile, so the value is not that important. But it tested the upper distribution. It held the just like I said in the homework. It tested the upper distribution. It held the 80. It tried from the 80 to the 74.50, and it couldn't get below the 74.50 and hold into the close. It ran out of time. It came back up and closed just above in 75. So barring any adverse news in Sunday night's trading, my hypotheses are going to be, one, what happens if it opens above Friday's range and VPOC? What happens if it opens below Friday's range and VPOC? And what happens if it opens in the range? What will I do? Okay, so I automatically have three pieces of information, or three pieces of three blanks that I have to fill out. And then I look at the overnight chart. So I switch session to the overnight, which we won't have one for Friday. We'll have one for Thursday. And I read the same stuff. Where is the overnight point of control? Where's the high? Where's the low? I know that statistically, and I just updated this last week, statistically the day session tests or breaks the overnight high or to the overnight low 96% of the time. So how close am I to the overnight low or high? Where am I in the range? If I got in, if I got in and it's in the middle of the range, if I got in, where would it want to test? So if it opened around the 78 area, I would look for another test of 80. But ultimately, it wants 81.5 and likely to take out and exceed 83. I think that's the highest probability scenario, barring news on Sunday night Chicago time. I expect that the market is going to turn up and test 80, 81.50, 83.50, and then ultimately close this 86.50 VPOC, and then if it has, depending on how big a range it is, it then can attack 88.75. That's what I would be expecting. The other scenario is it opens in the middle, tests 76.75, and then 74.50. If it can't find any buyers, it has no choice but to keep advertising lower prices down to 70.50 if it can't find buyers there. So it's a series of if then, if then. I will never, ever, ever do homework that says anything like It should do this, it will do this, it must do this. I'm extremely nimble. I could post that I'm looking to go short and then take a long, you know? And it's not because I'm changing my mind frivolously. It's because I'm seeing that the probabilities have changed based on some new information that came in, like the volume point of control, the VPOC, has shifted, so buyers are active. Like, what would make this point of control move down here? Can anyone answer that? To 74.50? What would have made this point of control move down here? Anyone want to take a stab? Nobody's going to laugh if you get it wrong. Sellers taking profits. Yeah, because they become buyers. You would need more volume trading down here than there is up here. So, and how much volume is that? We can see how much volume that is. All I have to do is click on the boundary. And so the volume down here is 49,000. The volume up here is 60-something. I need to turn off the... Wow. Anyway, I forgot how to turn this pink line off, but I can normally see that number. It would take, it looks like 50, what is it, 65,000? 65,000 contracts. I have 49,000 down here. So it'll take the difference, 16,000 contracts to move that VPOC down. Of course, Friday's done, so that's not going to happen. But in order to get 16,000 more contracts, buyers have to be active. Buyers have to interact here to move prices all the way down. If buyers move prices all the way down, the VPOC all the way down, and the market maintains above there, then that means the buyers are now taking control, and it's likely to walk itself back up. It's what I expect the overnight session on Sunday night to Monday morning is going to do. We'll see what happens. I'm okay with being wrong. Trading's not about being right or wrong. So that's what I see on the hard right edge. I look for where is my edge. I look for areas that I want to trade. I highlight those with these lines here, these gray lines. Okay, and then what I do is then stalk the market. How do I stalk the market? Since my trading machine is actually separate from my charts, I need the team viewer into it. So here's the team viewer. So, and since the market session is closed, I took a recording on our trading platform. I recorded a session from a while back. I think it was the 17th, the night of the 17th. And if I don't have anything I could show you as a concrete example since the market's closed, but I'm going to show you how I stalk using a hypothetical price. So let's play the session back. So right now it's the market open on the 17th. If I had, so this playback feature on the platform is essentially playing all markets, all charts back exactly as they were at that moment in time. It's recording every tick and it's playing it back, and I can trade any market just like it were trading live. Okay, this is the demo platform. Okay, so this is what the market was doing at approximately, let's see, 8:42 on the 18th, which was Wednesday morning. If I was stalking a, let's pick something. What do we want to buy or sell here? I don't have any homework at this moment to lean against, but if I was looking to stock short, I'm going to speed this up a bit. Okay, I'm stalking to sell. What I'm looking for on the platform is for price absorption by the offers. Okay, so this is the hard right edge. And what I like to do is actually show my fills on my fills are on visible. Okay, good. So let me test it. Okay. So what I'm looking for, let's speed this up. This is really boring. The market's not doing anything. Let's speed this up quite a bit, 10 times. what I'm looking for, let's say I'm stalking 82.50. Will we get to 82.50? I'm stalking 82.50. The market has come from lower prices from the 77 quarter key level, and it's approaching 82.50. Again, I don't do this in the middle of nowhere. I do this against levels that I want to trade. What I'm looking for when I'm stalking short is I'm looking for price absorption by the offer. So if I'm looking to sell, I'm looking for these prices to remain as they are and for the market to absorb those prices and reload. So let's slow this down here. So as it moves up, let's say my price is 81.50. I'm watching this price. I'm going to stalk at a lower price just in case it doesn't get there. So see how it went from 1,400 to 800. It's printing, and then it drops, and it goes to 1,400. That's not. It's showing me there is no price absorption. It's the market's still able to. The buyers are still more aggressive than the sellers. The buyers are never more than the sellers because they're equal in volume, but buyers are still more aggressive. These guys are not defending very well right now. And I'm just going to stalk and stalk and stalk until I see that the market has gone from running up to going sideways. And many of you will use a moving average or a fast chart, like I can switch to a 1500 and start to look for the market to go from trending up to going sideways, and I will stalk. And if I can join, so this market's tried several times to get these prices and it's not able to. Again, 81.50 is not an area I have homework for that I can trade, but we're using this as an example. See how it runs through? See, remember when I said it's not able to hold prices? See that? So this is kind of anticipated. I'm not seeing aggressive. What I want to see it is printing on the 82.50 or 82 quarter, and as it prints size, I want to see the offers coming back. Almost like, oh, you want to take them? Here's some more. Here's some more. See how this bar is getting larger? That's absorption right there. That's my first clue that I might get a small rotation, small enough to be able to execute a trade against. Let's make this trade mechanical. So I'm just going to set a strategy real quick, just so that I don't have to fiddle with this and talk at the same time. 5-tick target on the first, 5-tick stop, 10-tick target, 5-tick stop, and then let's make this a 15-tick target, 5-tick stop. Not trailing, just a stop. Okay, so now I've got the strategy loaded. I'm going to arm it, and now I'm looking to enter my trade. Okay. Again, I don't remember what this day did. This is in the middle of nowhere. I don't know. I don't have any levels in this area, but I don't want to sit here for hours kind of stalking a real trade. But so I'm looking for price absorption here. I need this to hold now for the short. I need this to hold. I don't want them to fall into the thinner part of the profile. So I'm stalking. See, there's no real good absorption here. They shouldn't be able to do that through here if I'm going to see some. See how now it's starting to break higher. Now all these people who traded right here, all this volume that traded right here is going to start puking them out. They're going to start covering their shorts. So the market's able to move more easily through these prices. The absorption that happened is not taking effect. See how these bars are starting to move? It's because these people who tried to get in here for the rotation are having to cover. Again, I only do this in my areas to do business. I don't do this in the middle of nowhere. I'm doing it in the middle of nowhere just to show you an example of how I'm reading the dome. I'm looking for how fast are prices printing on the offer. Is it being absorbed or is it being rebutted? Is this 1400 going to stay here as it prints the 83s, or is it going to pull off? Okay, see this absorption happening? See how this bar is rising? In order for that bar to rise like this, there has to be a seller in there. Otherwise, there's nothing. That's a fake bid. I'm going to hit the market. I'm filled. Okay? Taking slight heat. And while the market's doing this, I'm looking for my first scale out. I don't care about this trade. It's just one trade. It's either going to win or lose. It should not be pushing into this. Again, I'm taking this trade against an area in the middle of nowhere. I don't have any backup here. They're trying to, there is some absorption here. It's probably going to lift my stop. And then what I'll try to do is actually manage the trade with the trade analyzer. And what I'm interested in, as soon as I get my fill on my first target, I'm looking for my theoretical average. And what my theoretical average is it's computing for me, and I keep this up all day. It's computing for me after I get my first fill. What is my theoretical entry price? So I just got stopped on that trade, another trade taken, another trade lost. It's fine. Okay? Again, I took that trade in the middle of nowhere, but I'm trying to describe to you how I'm reading the dome. The way I manage the trade is as my key objective after entering the trade, my key objective is to get the first scale, because that's how I'm mitigating risk. As soon as I get the first scale, what I'm doing is I'm taking the profits from that first scale, adding them to the average that I had, okay? And this is just a random example. I'm adding them to the average that I had, and I'm recomputing what my theoretical average is. So for this trade, my average was 82.50. The market's trading 83.75. Had I gotten the one, so 82.50, my first scale would have been 82.50, 1, 2, 3, 4, 5, 81.25. Had I gotten 81.25, right, that would have been $62.50 that you can add to the average on the two positions, so it's half of 62.50, and then you recompute your theoretical average so that if I move my stop on this trade to that new theoretical average and it gets taken out, in the worst case scenario, I would have flattened the trade. What most people do though, as let's sell again here. Note the sim is not triggering right away like most other sims do. It tries to cue the trade. So I'm trying to get this 82.50. If I get this 82.50 on a 3 lot, the 1 lot is going to be worth $62.50, but I have 2 contracts left. So half of the 62.50 would be what, $31.25 would be added to this average, so that $31.25 is equal to 2.5 ticks. So now my theoretical average is 84.25. So now I've just given, even though I entered at 83.75, my theoretical average, or the break-even point of the trade, is suddenly 84.25 or 84.50, somewhere in between there. Okay. I'm not going to move my stop, but I've just improved my risk profile so that if the market takes out the 85, which is where my stop is, the damage is going to be 3 ticks on 2 contracts as opposed to 5 ticks on 3 contracts. Do you follow? Did I lose everyone here? I know that's hard for some people to understand. It's a lot of math. Okay, and that's what the trade analyzer does. And I've had this trade analyzer since 2004. I had it built for my XTrader Pro as an external tool, but now we have it built into our trading platform. And in addition to that, it keeps statistics for me on the maximum favorable excursion in ticks, how much heat I took, what is the best scale out in ticks per contract, how much time I remained in the trade. And I don't have it running right now because the market's closed. It's going to give me a blank screen. On the daily chart, it'll give me these statistics plus a couple more for every trade for the day, and then what I do is have every trader, every client save those statistics, because then we can study how much heat they typically take in a trade, what is their scale out method, so that when I'm troubleshooting their issues, and that's what I do in addition to trading, that's what I do most of the day, is take clients who are obviously struggling with the market and try to help them to trade on the hard right edge by doing the proper homework and so forth. And the statistics that come from the trade analyzer are key to that. Okay, so that's that. So that's stocking a trade and so forth. I'm going to go over the risks or the issues or the common pitfalls to the typical struggling trader. But I want to re-emphasize, so we don't need to look at this anymore. We'll let that trade play out, whatever. I want to emphasize that the same homework goes for stocks. So here's Apple. The same type of homework. I'll look at the composite. I'll look at the daily chart with the composite. You know, this is a simple Apple chart. So actually, it just got the fill on that other contract. So right now, my theoretical average is up here at 84.50. So if I move the stop to 84.50, I would net 0 contracts or 0 P&L on the trade. So now I can let this trade kind of do its thing, and it's got plenty of room. The average rotation or the typical rotation in the S&Ps is 2.5 to 3 points, 84.50, 2.5 points, 82. I would scale something out at that level, typically scale something out at that level, and see that theoretical average shooting up again. So that's what the trade analyzers is supposed to do. Back to Apple. I know I'm throwing you all off. I'm trying to keep you all awake. Back to Apple. So this stuff doesn't just work in futures. It works in, not that it works, but this methodology, this approach is something that I use in whatever I trade. It doesn't really matter. Okay. The difference is how I present the information. So if I look at the profile for Apple, I look at it in 5-cent increments, and I smooth prices by 5. Okay. So now I have Apple coming into Thursday, nice, beautiful acceptance zone in Apple from about 95 all the way to the high. The most accepted price for most of the day was $600. Okay. The market later in the day breaks through and very quickly rejects prices from $91 to $95. Okay. The next day, it opens at 91.83, tests lower, pokes and tries to find sellers below the prior day's low, couldn't find any, so shoots back up. Where does it shoot back up to? The most rejected price of the day, 95, 94.62 right here. And then from there on out, it's just selling. It just could not exceed the most rejected price, the first most rejected price from acceptance. So this is acceptance in the morning. This is the first most rejected price of the day. So that's a key LVN. And then the market settled down here with the most accepted price being 87.99. Okay, 587.99. When it couldn't find sellers below the prior day's low and shot back up, it held right at the LVN. Okay, it was previously rejected. It was the price that was previously rejected from the prior day, and that's the price that it held, and now it started its walk all the way down, and as it walked down, the VPOC went from 90 to 85 to 82, down to 75, and then finally rested at the low of the day at 72. That's not a good sign for Apple. And then if you look at the big picture with Apple, let's go to a 60-minute bigger picture. Look at Apple's volume distribution. You have what Apple's doing is it's made new all-time highs, and it traded a fair amount in these all-time highs. It has certain prices that it likes, okay, right up here. but now it's getting into the low volume nodes. If Apple does not defend the prices from 570 down, if it's not able to defend these and go back to the most accepted prices, it is likely to run through to 545. So I'm not going to say mark my words, but that's what the auction is showing. It's showing that it is no longer interested in these upper prices. Okay, so one of the things I look at to determine what is the bigger trend, what is the big market doing. Let's go back to the ES. So I'm just, for that Apple example, I'm showing you simply that it applies to everything. But let's go back to the ES. This is the profile in the ES without the price bars, without the noise. Okay, and so what is this important for? It's showing me the most accepted price for the day and the trend that it's in. That's how I define trend. Most people define trend as higher highs and higher lows, or lower highs and lower lows. I define trend by what prices are being accepted the most. And in order to do that, you have to look inside the bar. In order to look inside the bar, you can't beat volume, because the volume that's traded at price on any given period is irrelevant of time. So a 5-minute bar's volume profile looks just like a 10 minutes, looks just like a 60 minutes, looks just like a dailies. Okay? And so there is no talk of if the 5-minute closes below yesterday's low. But why is it important the 5-minute closes below yesterday's low or closes below the moving average? How is that relevant? To me personally, that doesn't make sense, but it makes sense for others, and I respect that. But for me, it's a simplified thing. Is the VPOC moving up with the market? Uh-oh, we have a pullback. But the pullback just resulted in more buying. It looked cheaper, resulted in more buying. Remember, the red lines here are the most traded price of the day, or the volume point of control. Uh-oh, we have a rotation down or balance, but then it pops up, but it's having a hard time. Whereas the prior days, it's trading at the upper end. See how the VPOC is trading above or at the upper end of the prior day's profile? Here, what you have is a VPOC that's not able to do that. The sellers are active. So we get this correction, and I posted about this, and I think I did a video about this when it was happening, before it happened. And then we get these lower prices. Buyers are activated here. They start a new trend. Okay? VPOC, VPOC, rest, VPOC shift up. This is the Fed day. VPOC, VPOC, but it's getting weaker. See, the movement from day to day of the VPOC is getting weaker. Rotation back, cheaper prices, buyers are activated, VPOC moves up, buyers are activated, we have a pullback, buyers are activated, but then this VPOC does not exceed the prior high by much. I rang the bell on this. I posted it on Twitter to say, look out, this thing is looking weak. Okay? From there on out, it's down, down, balance day, broke lower, and now we're in this muddy, crazy. Look at the VPOC in this zone. What do you think of that? What is this telling you, this zone that we're in now? This is from the 5th to till yesterday. This is where I draw a composite, right? Because this is imbalance. So I'm looking at a composite, and I'm trying to read what's happening within the composite. The key areas here, 80, 77 quarter, big area. So 80 is a rejected area. 82.75 is the most accepted area in the zone. 80 is rejected. 77 quarter is the next most accepted area, and so on and so forth. Let me bring this to the front. So this is just showing me the volume at these prices. Very blunt. Markets just running through these prices here, all the way down to 70. Very blunt. Markets just not finding consensus. They don't think the peanut butter is priced well yet. Some days they think it's too cheap. Some days they think it's too expensive. And if you've had a hard time trading in the last week or so, The auction is telling you that. The auction is spelling that out. There is no consensus on price. There's just no consensus on price. So you play light and tight. You keep your risk under control. Moving on. So this is an important chart for me. The VPOC shifts, how they move, how the most accepted price moves is a key chart for me. So it gives me context. Okay. Some control pieces of information that I use other than the trade analyzer. I'm looking at internals. This chart down here is the S&P 500 tick. I do not look at the New York Stock Exchange tick. I just personally have done a lot of testing. I don't really care that a universe of 8,700 prices are ticking up or down. I'm trading the S&P 500, therefore I want to know how many stocks within the S&P 500 are up ticking or down ticking. I did a lot of studies on what is an extreme tick in the S&P 500 tick, and what I did was I took 1 minute tick data, and I ran a profile on it, and I figured out that the second standard deviation, or 95% of the time of the data set, the tick stays between 250 positive to negative 275. Anything exceeding that has 4.5% chance of occurring. So I have these horizontal lines up, and these horizontal lines, these dashed lines, are the limits for the tick, for what I would consider to be the norm, or in this case 95% of the data set are between these lines. Anything exceeding that would tell me that there is an extreme, there's a basket that's over trading the underlying versus the futures, and so I have audible alerts against it, right? Cork pop. So I have audible alerts when that goes off. When that goes off, it tells me that the tick is exceeding those limits. Okay, so that's the tick chart. I don't cue off of it. I don't initiate trades based on the tick or any underlying internal. What they are trade support tools. My priorities are homework. Where am I looking to do business? My second priority is stalking the trade, the dome, looking at what is the market doing. Is it absorbing or is it pushing through? Once the trade is on, it's mechanical. And that's the part that we're going to talk about here for about 10 minutes. It's mechanical. The trade analyzer tells me where my risk is through the theoretical average, and very simply, I'm managing the trade using that. And then what I do is I use the internals like transports right here to figure out what are the key sectors of the S&P 500 doing. So transports, technology, financials, to get a pulse on what the underlying is doing. And of course the VIX, I don't care about the VIX all that much. It's really an erratic thing to watch. And then off screen here, I use the breadth. And remember, I don't use these on the New York Stock Exchange. I use them on the S&P 500. That's all I'm interested in, the S&P 500. I don't need to see the full. I don't really care that a whole bunch of, 10 million market cap stocks are upticking at the same time. I don't care. I just care about what are the stocks underlying the S&P 500 doing. Okay? I hope that's clear. So let's move on. Let me switch screens here. All right. Common pitfalls. What do struggling traders have trouble with? So let's go through the common pitfalls and then talk briefly about what needs to happen. The common pitfalls are not understanding risk. You think you understand risk, but do you really, right? Do you really understand how badly things can go if you size your position poorly on a small account? Knowing that leverage is a big part of futures trading, and it's a huge advantage to futures trading. That's why I never went back to stock trading. Once I started trading futures, it was over. I stuck with futures. It just made sense because of leverage, because I don't need that big an account to control a sizable position to make a living. And with that comes risk, more risk, okay? So understand risk. The second pitfall, not having a clean and vetted plan. Most everyone believes that they can kind of wing it because in school they can go take a test and they can kind of wing it. At work, they go to work every day, and when a problem shows up, they can kind of wing it. And really, you need to have a plan. And I'm not talking about the type of plan that NASA puts together for a shuttle launch. Not talking about that. It doesn't have to be that detailed. It simply has to be something that forces you to be methodical. That's the key. Okay? So at this point, I would throw out 50 different sports analogies, but I won't because I'm running out of time. But essentially what you need is a flight plan for your trading. Something that says, okay, before I take off, I have this checklist that I'm required to do. The checklist says I need to check economic figures, speakers, then I need to check the monthly, then I need to check the daily. Within that daily, what do I need to check? And then I move into the intraday chart. I'm going to go from 30 minutes. And within that 30 minutes, what am I going to check? Then I'm going to move to my 5-minute or trading or execution chart. What am I going to check? I'm going to move to the overnight and see what's happening there. What am I going to check? So on and so forth. Okay? And in addition to that, you incorporate your homework. And your homework can include all kinds of research. I have spreadsheets like I'm an economist. I have a ton of spreadsheets, and they're important to me. I know that the edge or whatever that's shown in the spreadsheet is a long-term data set. It's a past data set, and I don't expect it to always happen the way the past data set says that it will. And I know that the next trade's outcome can be a win or a loss, but it helps support my thinking. So that's what I mean by a plan. The bottom line with a plan, what you're trying to do is create a procedure and become mechanical about that procedure. In addition to that, what you want to do is end up being able to monitor what you're doing. If you can't monitor what you're doing, then it's practically impossible for you to figure out what is wrong when things are going wrong. So that's essentially what I go through. This is why I post this stuff in the chat room. I'm constantly telling our traders to post their plan. That's a requirement almost. I can't require somebody who's a client to do anything, but if you know what's best for you, you should be putting out, not just thinking about, not just putting it on a piece of paper in front of you, but actually expressing in public what your plan is so that so others can look at it and others can learn from it, but also others can tell you, whoa, you missed something. Like this person here. See, this particular client here, my stuff is in bold black. Clients, in the chat room, everybody's color is the same except mine is blue. But in the log, it shows up as gray. But this is a client posting his plan, and everybody in there is encouraged to do that. You're encouraged to do that wherever you trade. It doesn't matter where you trade. You're encouraged to post your plan if you're in a chat room, if you're on Big Mike's chat room, if you're in a forum where you're doing a trade journal, post your plan, put it out to the public. a thought gains much more power when it's expressed. Once you vocalize it or put it out there, it's much more powerful, and it allows the opportunity for you to stick to your homework a little bit better, and it allows an opportunity for others to kind of critique it. So what are you looking for in the homework? At the bottom, at the very, very bottom of it, you're looking for an edge, and an edge is not some percent. An edge is the probability of one thing happening over another, period. That's what an edge is. Okay? And so your homework and your plan is simply your method, your pre-flight, pre-takeoff check that says, get out of the cockpit, check the propeller, check the wing. Are the ailerons moving properly? Can you move the rudder? What's the tire pressure? That's the kind of thing that you need. You have to do it because it's those little pieces that make it so that when you're flying, you don't have to worry about those things. Okay? It provides you with the safest, least risky approach to trading. So that's part of trading on the hard right edge and sticking with the theme of this. The other problem is tampering and overthinking the trade. So you've done your homework, and I'd love to hear in this that somebody in this forum has not done this. You've done your homework, you've spent 3 hours on it, you know what you want to do, and then the trade shows up. The trade comes, and you go to put on the trade, and what happens? You close it out for 2 ticks. You put it on, it goes against you, 2-3 ticks, it comes back, goes for you, 2-3 ticks, it comes back to scratch, you scratch it. Okay? You're overthinking the trade. Once you put the trade on, with risk being defined, you need to be mechanical. You cannot be a pro basketball player, get fouled on a layup or a shot. You can't go up to the line and at that point start thinking about how you're going to do your free throw. If you watch professional basketball players, they bounce the ball exactly the same number of times every time. Okay? They look up at the rim at the exact same spot every time. They don't care if there are noodles, the fans are waving noodles behind the rim or whatever to freak them out. It doesn't matter. It's irrelevant to them. And these are the nuts and bolts of trading, the mechanical part. They have practiced that shot so many times before the game, and every day, all hours of the day, to the point that when it's time to get on the line and the cameras are on and everybody's watching, it's mechanical. And that's the biggest part that's missing with struggling traders. You're not mechanical about when you trade. You've done the homework, you've done the research, you've put your homework out there, you put the trade on, and it's a loser, so you hang on to it because you just cannot accept being wrong. If it's a winner, you cut it short because you need to boost your confidence by taking a 2-tick winner. You're tampering with your trade. Statistically and over time, it'll be very difficult for you to have a positive edge in your trading if you keep doing that. So identify the trade, identify your edge, wait for it to show up. It's a boring process, I know, but wait for it to show up, put it on. Okay? The other thing that messes people up, they don't obey risk. Not only even if they have defined it. I've defined my risk plan as I'm going to risk X% of my account per trade. I'm going to risk X% of my account per day. So I have a daily loss limit of some sort. And I'm only going to take, for me, one of the most important risk rules is I'll only take a stab in the direction of a setup 3 times before I have to stop. So if I'm trying to get short and I take 3 shorts in a row that end up in a loss, I can't take a short again. It's done. It's over. I don't want to fight a trending day. Okay? So that's part of a risk plan, okay, among other things that I have. The other one is not obeying your risk means you even if you've defined it, people will trade through their daily loss limit. So if I ask you, if you're a client and I get you in a chat room in a private message and say, what's your daily loss limit? Because we have alerts and alarms, and that's part of what we do here is monitor people's risk very carefully. You know, our goal is to try to help people achieve their desire to be successful. We can't guarantee it, but we do what we can to provide the service. So the alert goes off, I hear it, I pull up your account, I see how you're trading, I get a hold of you in a chat room and I say, what is your intended daily loss limit? If you don't have an answer, you're in trouble. You need to know what that is, because what's happening is the market keeps moving, it doesn't care how you feel, it's going to continue to go against you, and unless you obey some sort of a risk plan, you're risking a huge part of your account, and you don't have a chance to take enough trades to make it through the turn. And that's one of the key elements of not trading successfully. Changing methods too frequently. Okay, something's working. You know, trend line breakouts are working for me. Volume profiles working for me. Then for the last 2 days it has not. So what do? I go, I buy a book, I go buy a course, I go and talk to someone and try their method. That's a huge problem as well, and it's the most common problem I see online since I've become familiar with how the general public trades. Is you constantly change methods. You're constantly adding or taking away from your chart. That's not, just stick to something. Stick to something, even if it's throwing a dart, you know, stick to it, just get really good at it. It's so important for you to just decide what makes sense to you. A moving average crossover makes sense to me. Okay, get to be an incredibly smart expert at moving average crossovers. If you like Drummond geometry or Gann or fibs, just get really, really good at those. Stop doing fibs, then adding a stochastic, and then your buddy's using this custom indicator, and then you add delta, then you take away delta. Stop doing that. All of it works, and none of it works, and it's all a function of how competent you become at it. Following others. Don't follow others. Don't follow others' trades. Don't take a trade just because somebody did, because the moment of truth comes out as soon as you put out the trade. If you have not done the lower part of the iceberg, the part that's underwater, the grindy, grimy, hard work of putting together the plan, you're not going to be able to stick with that trade. Heck, people who have done the homework have a hard time sticking with their trade once they put it on. How are you going to do it? By just taking someone else's trade on. This is why I stopped posting my trades on Twitter. I used to post them all day, every day. It's useless. It's not very important. It's better to talk about what I see and the approach that I would take than to post the actual trade. The last one, not recognizing that their success and failure are linked to their psychology and discipline rather than to some technical failure or knowledge. The technical part is the smallest part of the puzzle, and that's the part that gets the most attention. That's the part that has the most books written about it. That's the part that all the sales and marketing and everything else is about. It's about selling you that awesome indicator, selling you that system. It's about using a 5-minute versus a 3-minute versus a point and figure versus all of that has importance, but it's so much less significant than your psychology and your discipline, and that's what I focus on. When I ran a prop shop, I did not talk about setups. I did not talk about technical things unless it was necessary. I focused most of my time doing what I do now with our clients, focusing on risk, psychology, approach. That's what I'm focused on. If you want to use fibs, go ahead and use fibs. If you want to use moving averages, doesn't matter. The approach is irrelevant, and the coin toss shows that. The remedy, last slide. The remedy, 1, understand risk and make a plan for it. Your monkey's a very tricky fellow. It's true. Most of us can outlie ourselves, really. Know that you can only pick up bits and pieces from someone else's approach. Ultimately, you have to find something that suits your personality, risk tolerance, and account size and speed. Okay? You have to break the shoes in that you're going to run in when the marathon starts. Right? Don't try to run in someone else's shoes. The results are not going to be very good for you. Okay? Whatever plan you decide to develop, stick with it. Trade it mechanically. Don't keep tampering with it all the time. Treat it like a lab experiment. In order to get proper results from a lab experiment, you have to run the experiment completely through. If you are putting on trades and managing them randomly and your entry is discretionary, when things don't work, there is absolutely no way you can figure out if your trade management's wrong or your entry is wrong. Okay? One of those is wrong. And the only one that you can really stick with, the easier one, I should say, that you can stick with is very mechanical trade management. I'm going to get in, I'm going to take this much for a scale, and I'm going to move my stop at this point. These are my targets, and you do it the same way every time. Trade something mechanically, you will be shocked at what you learn about yourself and your trading plan. And if you trade it mechanically, then you can localize your effort into focusing on the plan and improving your homework and improving your setups. But if you trade randomly, you execute randomly, and your entry is discretionary, it could be either one, and you'll just do what, unfortunately, I hate to say it, but 95% of the people, well, I shouldn't quote a percentage because I really don't know, but the greatest majority of people struggle with. And it's that, you know, they just churn and churn and churn and they don't make any headway. Obey your risk, obviously. When you've hit your daily limit, stop trading. Go to the sim. Keep trading on the sim. It doesn't matter. Go away. Go watch a movie. Just don't keep trading through your risk plan. It's the only thing that protects you from destroying your account and your emotional capital. It's your seatbelt. Okay? Every plan hits a losing streak. It doesn't mean that you should change it. Change your methodology. Simply determine what might be causing the issue and make refinement to your plan. Don't toss it. Don't keep changing your plan entirely. Keep refining the information in it. There's a lot of misinformation out there. Be confident and stick to what you like and what you said you would do. Don't follow others. Stick to what you have researched and are confident in. Your trading platform stability, internet connections, on, all these other things, technical things are important, and your indicators and so on, fine, they're important. But it is more likely that your psychology is preventing consistency in your trading than technical issues. Don't focus your attention on the technical part. It's the last piece. How big an engine you drive around the track in the next NASCAR race is an important piece, but it's you who's driving the car, who's running that engine, that needs to do it well. That's the part that needs to be fixed. Most people worry about getting the fastest car, but all that does is it plasters you against a concrete wall in a flaming ball of glory faster. That's all it does. So the key is to learn about yourself, what fears you have, and focus your attention on that first. And when you execute the trade the way you had planned it, as opposed to just putting it on and then just freaking out because your psychology is just not stable enough because you're full of fear. That's all I had. I'm sorry I talked through the whole 2 hours. I didn't think that was that much material, but I'm kind of covering a whole bunch of stuff.
Hey, man, no, you did absolutely fantastic. I have to say, what is this, like the 4th webinar on BNT that you've done, I think? This is the best one. Especially because I really know how much people want that detailed information on your thought process, on exactly why you're making certain trade decisions. You can tell people how important it is to manage risk and how important it is to get a grip on their trading psychology. But what everyone really wants is the process. So I think that this is going to be a home run.
You keep saying that every time, and I appreciate that. It's a huge compliment to keep saying that this is your best yet.
Yeah. We'll just keep doing it then. That's a good trend.
Let's look at it this way. I hope I threw out so much information out there that there are no questions. No questions left because it's so clear.
Well, I did see a lot of people that were asking about the room that you mentioned, so you might want to make it clear how people can get to that room. And I think a lot of people also don't quite understand, so you might want to explain that you are FuturesTrader71, .com, and that you also have started, a brokerage. So you might want to just clarify that.
Yeah, I hate to sound salesy, so I try to avoid talking about brokerage as much as I can, although a lot of what I said today was relevant to what I was doing as a trader and what I've learned and we're trying to do different as a brokerage. So I'll address the brokerage first. The brokerage was intended as the next natural transition from what I was doing online, which I felt wasn't getting anywhere and was actually burning me out, in that I was helping a lot of people through email and Twitter and a lot of chats. I would do 1 or 2 chats a week or something, impromptu chats, and I felt like I was answering the same questions to the same person, and then eventually they come back and say they blew up their account. So I felt that the best way to, instead of putting out webinars and doing all that stuff, I felt that it would be better for the trader that takes the opportunity to join, who's really committed, and that's who I'm interested in really, is the trader who's really committed to trading and making the turn. If they are committed enough to join a brokerage which has competitive rates and all that jazz, a very stable platform. I have not seen this platform crash yet. It trades beautifully live. If they join it, then in return for joining it, then we can treat them like I treated my prop traders. I can make sure to be involved in how they determine their risk. Although we have $500 or $400 margins, we don't give that to anybody, because I know that that's a very, very big knife to run down the stairs with. You know, so we control risk. We set the limits for each trader that comes in. We have a chat room that is dedicated. It's noiseless, it's clear and clean, and it's dedicated for traders that really want to make it. And this is something that's truly unique in the brokerage business, because most of the time your broker just gives you a platform, gives you a cut rate, and you go and do whatever you want to do, and you know, I'm going to quote you a price, and then I'm going to move on and make the next call so I can replace you once you've blown up, right? And so that's not our intent. Our intent is to create the first ever brokerage that's built like a remote prop trading group like I had here in the Chicago Board of Trade. So continuous education. I do a lot of webinars. We had a webinar yesterday by one of our clients, a guy who's experienced in market profile. People trade whatever method they want. It's not a volume profiling brokerage. It's whatever you want. We have, you know, we have Forex options, whatever. And so we had this gentleman who I've known for a while come on and present what he does, and that's for clients to see another perspective. And people talk to each other in there. They message each other and they exchange information. Some of them meet over Skype, and that's what I'm trying to build. I'm trying to build what I had on the Twitter stream and what I had on my website, but include the brokerage in it so that I can actually see what your problem is. And I do trader intervention. So if I see that you're blowing 30% of your account in a day, and many people do, you know, not with us, but traditionally, I would, you know, call them that day and pull the trade analyzer and look at all their trades, do a trade run, just like I did with one of my traders that's having a hard time, and give them some sort of an exercise that they need to go through and so forth. And so that's what that's about. I have no interest in brokerage, to be honest with you, other than I believe it's the best way for me to transition from just talking in a big, loud abyss of, you know, black hole of information that is Twitter, to actually focusing on those people that actually come over and make the transition. So that's what the brokerage is for. I forget the other part of your question.
Well, it gives them accountability too, you know, and you know me, I'm a big fan of trying to get everyone to do a journal on the forum. And, you know, last month we had this big contest to try to encourage everyone to journal. And that's a form of accountability, but you take it, you know, to the next level of at the broker level, right? I can just picture a trader who has told you their loss limits and who is completely violating it and just blowing it up, and then their phone rings. And I can picture it.
You know what people say when I call them? They say, the first thing they say is, "Oh, FT, Thanks for the call. I know why you're calling. I'm going to shut my platform off right now.
Yeah.
And in some cases, I call them to say, I'm going to put you on liquidate only. I'm going to lock up your account for your safety. Do I have permission to do that? Let's work on, doing some coin tosses and some exercises before we go live again. Now, any broker would probably shoot me for stopping someone from trading, but I believe that that's what you have to do to preserve a client's best interest, and that's really,
Right.
that's like that's what I want to stand for, and that's what we do. So it is important, I think, to help people who are just trying to kind of figure it out. They're doing the best they can, but with poor information and poor support.
Right. Well, the second part of that last question was your website, and you mentioned sometime during the webinar, you referenced another webinar that you had done, I think webinar 4.1 you said.
Yeah.
So I want to clarify all the ones that you can get on your website.
So 2 years ago when I came on and started talking about this stuff, there were so many questions that I couldn't answer, and I did so many chats. I mean, you can go to the website and go to the chat log, and it's just a lot of information. So resources, chat log, and it's just, they go way back to the first webinar, which was the 15th of October of 2009, and it was just impromptu stuff. And so what I decided to do is create these webinars that just break it down, and so that when people come in to ask questions, I essentially tell them, go get the webinars. And the webinars are a donation, and they're extremely underpriced at $129 or something like that. And I'm basically opening up my research and my approach and what's important to the folks that want to see what's there. And then what happens is then they can come back with more specific questions, as opposed to me repeating the same stuff over and over and over. And the series was supposed to be, I created a study plan or an education plan of 12 webinars. I got through the first 4, and I noticed some things that I didn't like, and that people were just taking them, reproducing them, and selling them at higher prices and things like that. And I also found that the more webinars I did, the more questions, the deeper I got. And so I thought, that's another thing I wanted to do for clients, is that if I have a focused group of people that I know how much money they have, I know how they're trading it, I know what trades, I can pull up your trades going back 6 months in the platform and see day by day what you've done. Those are very useful tools, and so I've taken the education that's on the website and transferred it to a client-only approach. So we try to do on a weekly basis, do some sort of webinar on something, and I have an education plan for clients, but we're not at a point where we can launch it at them yet. But that's essentially what I've done. I've taken what I used to do publicly, and I still do. You can see there's a webinar there from April 17th at the top of the list. I'm just focusing it on the people that I can help and interact with.
All right, man. Well, I really want to thank you for your time once again this Saturday. And we'll definitely do it again soon, and we'll work out a topic, that will help the most people, and we'll do that next. Everyone that's asking whether or not the webinar is recorded, yes, it's recorded, and I will post it later tonight if I can get to it. Otherwise, it'll be tomorrow. You can go to bigmiketrading.com and check it out. And I also sent them to FT71, and so he can tweet about it for everyone that's following him. All right, guys. So once again, thank you very much. And if there's not anything else, then I'll let everybody get back to their weekend.
Thanks for having me. Take care.
Thanks. Bye.